So my point is this. Right now, the market's pricing in 4 rate cuts, right? If they do nothing, right? We saw last year, nothing is not enough. Now, there will be a surge in yields, and that'll be somewhat negative. But to really affect things, it's now clear they need to put hikes on the table. And they're not doing that right now. But the problem is, if you go from 4 rate cuts to a hike or 2 hikes, I believe you're going to have like a 200 basis point surge in the 10-year yield. If that happens, the Mag 7, the entire stock market is going to implode.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. The markets, and specifically the Magnificent Seven, or 6 or 5 these days, are reflating, propelling the markets to great heights. Budget deficits are blowing out as if the U.S. was either in war or recession, and yet it is in neither. Many are expecting the Fed to begin lowering interest rates soon. However, inflation data is ticking higher, prompting the question, should the Fed actually be raising rates further instead of lowering them? The consumer seems to be running on fumes, and the banks may be teetering on a knife's edge. To discuss all of this and more, we're fortunate to have Gordon Johnson on with us today. Gordon is the founder and CEO of GLJ Research, a differentiated research boutique committed to identifying unique value opportunities across a broad range of industries and sectors, and he provides in-depth coverage of specific companies. Gordon has more than 15 years of experience as an equity research analyst and was recently ranked by Bloomberg among the top stock pickers. Prior to focusing on certain sectors, Gordon covered semiconductor technology and solar companies at Lehman Brothers. He's been recognized for his accurate stock picks in numerous publications. Gordon, thank you so much for joining us today.
Hey, thanks for having me, Gary. It's a pleasure.
All right, Gordon, let's start with the markets. What is your 10,000-foot view of the state of the markets and the economy right now?
Gary, I was late to the call today because I was putting out my macro views. I apologize to you and your viewers. These are my, but we put our views out. So, taking a step back, listen, nobody is no one is clairvoyant, right? In trying to predict markets, we're trying to predict the future. And that's impossible because we don't know what the future is going to be, right? So I want to provide that disclosure, if you will. But what we look at is we look at U.S. liquidity. And the way we define U.S. liquidity is taking the Fed's balance sheet minus the change in the Treasury General account balance minus the change in the reverse repo account balance to get U.S. liquidity. And effectively what that metric captures is the private money in the banking system, which we believe is the most akin or most reliable source for liquidity. Now, some people on Twitter and other outfits have accused us of focusing only on reserves. But I want to highlight something. They say that metric is reserves. That's just factually incorrect. So as of the week ending January 21st, our liquidity metric was 6.24 trillion. Bank reserves, I'm looking at my notes here, were 3.52 trillion. So that isn't bank reserves. Now, I want to give you some history, Gary. Since 2009, that metric, that liquidity metric, if you track it against the S&P 500, 88.9% R-squared correlation, statistically significant. I want to give you some stats. 2018, S&P 500 down 6%. Our liquidity metric down 408 billion. 2019, S&P up 28%. Our liquidity metric up 102.8 billion. 2020, S&P up 16.3%. Our liquidity metric up 1.94 trillion. 2021, S&P up 26% or 27%. Our liquidity metric up 1.1 trillion. 2022, right? When nobody thought the S&P could fall. S&P down 19%. Our liquidity metric fell 982 billion. 23, S&P up 24%. Our liquidity metric up 332 billion. And year-to-date 2024, S&P is up 6.7%. That's as of yesterday. Our liquidity metric up 58. So it's been perfect going back to 2018, predicting the move in the S&P 500. Now, with respect to what I think about the markets, what Janet Yellen said in her January 31st quarterly refunding announcement is that in Q1, she's going to issue a net positive $442 billion in T-bills. That's short-term treasuries. That represents 57% of the total funding of 760. Why that's important is because historically, before Janet Yellen shifted to issuing majority T-bills in Q4 of last year, the Treasury normally funded its operations only with 10 to 15% short-term debt, right? She's doing it with 57%. Why is that important? That short-term debt she's doing T-bills is being funded out of the reverse repo account, which means because she's issuing so many T-bills, the balance of the reverse repo account is going to fall in Q1 of this year. Now, what does that mean? Again, I just explained. A fall in the reverse repo account is a net injection of liquidity. What the reverse repo account is effectively as excess quantitative QE infinity money that was printed from 2020 to 2022 that was sitting dormant, right, on the Fed's balance sheet. That wasn't money finding its way into the real economy. And then when Janet Yellen in Q4, after the debt ceiling was resolved, shifted to issuing short-term debt, those short-term yields were higher than what you would get by parking your money into the RRP. So money flowed out of the RRP into short-term treasury bills, thus funding Janet Yellen's issuance. Typically, that money is funded by bank reserves, and bank reserves have a very high correlation to what the stock market does. So even though she had the TGA balance had fallen to 50 billion, she needed to get it back up to 800 billion, which historically would come out of bank reserves, which would be very bad for the stock market. You had this reserve of currency sitting in the reverse repo account that funded her debt issuance. Thus, you had a resurgence in risk assets because bank reserves were able to stay elevated. So Q1, I think we continue to have a melt up through March 31st. However, looking to Q2, and again, in the January 31st QRA, Janet Yellen has said explicitly that she's going to retire. So she's going to let a net negative $245 billion in T-bills mature. So you're going to have a negative issuance. So what's that mean? That means the drain in the RRP that we've seen since basically the debt ceiling was lifted last year is going to stop. And then I want to talk about inflation as to another headwind. So we think you have a continued melt up in stocks. Stocks up again today. They'll be up almost every day until this is done through March. And then we think you have hell to pay, if you will, excuse my French, when that RRP drain stops. Thus, you stop this liquidity flow into the market. And in addition, you have a reluctance to buy treasuries. And I want to talk about the 20-year auction that happened on Wednesday, which was a disaster. I want to talk about that too. But so stocks up in Q1 and Q2, we think stocks fall a lot overall.
Wow, that was power packed, and you actually answered my next question, which was specifically about liquidity. And so your metric that you're tracking, just to sum up that real quick to make sure I understand and the viewers understand, what you're seeing is that the RRP drain, once that, as it continues, that's more liquidity injection. Markets follow along at an 88 point something percent R squared. But then once that stops somewhere around March, April, you're projecting a decrease in liquidity, which means the market's going to drop. But because it's overextended, you see even a bigger drop than maybe what normally would be correlated.
Right. So that's a great point, Gary. But I want to talk about two things here. Number one, so there was a 20-year bond auction on Wednesday. It was a disaster. And let me explain what I mean. So the TEL, and hold on, I'm just going to look at my notes here. The TEL, that's what the government had to pay in bond investors. So the TEL represents the difference between the rate the government wanted to pay to borrow versus the rate they had to pay. And when there's a TEL, that means the government had to pay more than it wanted. So that means, there was less demand. So they had to basically, increase the pot, if you will. So the TEL on the 20-year bond auction on Wednesday was the largest in history. In addition, you had indirect offers. So the indirect percentage fell off a cliff, fell from 62% to 59%, meaning demand for the ever-increasing piles of U.S. government debt that Yellen has to issue this year is falling. And it's being led by a fall outside the U.S. So what that means is that's a signpost for trouble financing the U.S. government's massive debt issuance this year down the road. Down the road being starting in Q2. Actually, clearly it's starting right now with the horrific results of the 20-year bond auction. But in Q2, again, she's letting a net negative $245 billion in T-bills mature. She's issuing a net positive $447 billion in coupons. So that's longer term, longer duration debt. So that's one dynamic. And the second dynamic, and we could get into this, is what I believe is an overheating in the U.S. economy right now, i.e., the data points suggest the Fed should be hiking rates, not cutting rates. Let me explain. So in Q4, you had nominal GDP 5.8% year over year, which is indicative of a very strong U.S. economy. Number two, you had a record surge in corporate investment grade bond issuance in January of 2024. That was following a sharp drop in bond yields as well as tightening spreads at the end of 2023. So what that means is corporations are salivating to lock in rates at 4% at a record level because that effectively means they believe rates are going to go higher. And keep in mind, corporations have the best read on the health of the economy, prices, inflation, etc. So if they're issuing a record amount of investment grade debt in January, that's them telling you rates are going higher. Number three, household savings rate is currently near a multi-decade low, meaning consumers are saying they will not forego consumption for savings. Why is that important? Because you're now getting 4 to 5% on those savings, an amount we haven't seen in decades, right? Despite that fact, consumers are saving nothing, right? Number four, you've had an inflection in mortgage applications. And then number five, you've had a number of inflation data points inflect higher. ISM prices paid, NFIB wages, CPI, PPI, etc. So all of this data, it doesn't just suggest to me, it clearly shows the economy is reheating at an elevated clip. And if the Fed is data dependent, which they say they are, which clearly them still talking about cuts suggests clearly they're not. But if they're data dependent, they should be talking about rate hikes to calm this down, not rate cuts. One other thing I'll note. I'm sorry. Go ahead, Gary. I'm sorry.
I was going to say, I've got questions on all of this laid out. If we could go back to the markets, I'm going to go through each one of these points that you've made, because I think every single point that you've made is critically important and something that's, for the most part, lost on most people. Most people are thinking it's happening on this side of the boat, and you're saying, no, it's on this side of the boat.
Right.
And yeah, so I want to touch on each of those a little bit more in depth, but I wanted to ask you, do you equate the Magnificent 7 or 6 or 5 with the .com and Nifty 50 stocks? And do you expect to see a similar outcome? Or is this time different and the Magnificent 7 is just completely unique in history where the valuations are going to ultimately remain stretched above the mean indefinitely?
Yeah. So I can't give recommendations on stocks I'll cover, but here's what I'll say. One other thing I wanted to note is, people talk about the jobs market. And if you look at where we're trending, I think we're trending at around 350 to 400,000 job ads per month. And the problem with that is the replacement rate of jobs in the U.S. economy is 50 to 90,000. So we need to see job growth decline to that level for there to even be any concern. So the idea that the Fed is using the jobs, the job additions to cut rates, the job additions are yelling you should be hiking rates, not cutting. But getting to your Magnificent 7 question, I want to highlight a few things. So there's a number of ways you can talk about whether the Fed's current policy is tight or not, right? They keep saying our policy has tightened financial conditions. The reality, however, Gary, as you know, using the Goldman Sachs Financial Condition Index in November plus December of 2023, you had the loosest, the biggest loosening in financial conditions ever over a 2-month period, right? And yet the Fed's saying it's tight. Keep in mind, that's looser financial conditions than we got after QE1, QE2, QE3. So I want to talk about this. So if you look at market rates, and I just want to say something, right? Everybody looks at the effective funds rate or the Fed funds rate, right? EFFR. That rate does not determine what happens in the economy, right? What determines what happens in the economy is market rates or U.S. Treasury yields, i.e., car loans, mortgages, consumer loans, corporate loans are priced off of what the 10-year, 5-year, and 7-year and 20-year U.S. Treasuries are doing. The only, and not even banks, right? Banks are getting deposits at 5 basis points. So the only thing the effective funds rate does is try to impact what market rates are. But when they hiked effective fund rates, and then minutes later, Powell gets on the Q&A and starts talking about rate cuts, right? They're hiking the EFFR, and yet the market rates are declining. Why? Because they're giving you this guidance that they're going to cut rates. So they're completely, basically washing over and basically, walking back their rate cuts. So the Fed is making a huge mistake over and over and over again. But I want to talk about something. So if you look at the 10-year, there's ways to measure tightness in the rates markets. You can look at the U.S. Treasury yield versus nominal GDP growth. If you look at prior recessions, the 10-year U.S. Treasury yield, in every prior recession, the 10-year Treasury yield went above nominal GDP growth. However, right now, the 10-year Treasury yield is at 4.3%. We have 5.8% nominal GDP growth. Things are not tight. If you move to, the 10-year Treasury yield versus the effective funds rate, in the 1990s, the effective funds rate, the 10-year Treasury yield got up to the effective funds rate. And then, in the late 1990s, early 2000s, the 10-year Treasury yield overshot the effective funds rate. And then in, the 2006, 2008 timeframe, it matched it. And then in the 2020 recession, it overshot. But in this period, right, 2022 to now, you haven't had the 10-year Treasury yield shoot above the effective funds rate. That is clearly indicative of loose monetary policy, not tight. And then if you look at the 2-year Treasury yield versus the effective funds rate, and the reason I use the 2-year Treasury yield is because that's more short term in duration, so much more closer to the short term end of the curve. It too is undershooting. The 2-year Treasury yield is undershooting the effective funds rate. So my point is, policy is not tight. And here's the problem, Gary. Here's the problem. Keep in mind, right? People are talking about, right now the market's pricing in 4 rate cuts. That was as of 2 days ago. I haven't looked today. And the market was pricing in 2 rate cuts in 2023, right? What happened? Let's talk about what happened. You didn't get any rate cuts, right? Not only that, the 10-year Treasury yield was above 4% in all of the back half of 2023. In fact, it hit 5% at one point. So, right, that should have been restricted. What did we have? We had an explosion in economic activity, right? You had an explosion in stock prices. You had a record easing in financial conditions, and you have inflation now inflecting higher. So clearly, the policy last year was not restrictive. So the idea that even if they pull back on these expected rate cuts and keep rates flat, that is not enough. So my point is this. Right now, the market's pricing in 4 rate cuts, right? If they do nothing, right? We saw last year, nothing is not enough. Now, there will be a surge in yields, and that'll be somewhat negative. But to really affect things, it's now clear they need to put hikes on the table. And they're not doing that right now. But the problem is, if you go from 4 rate cuts to a hike or 2 hikes, I believe you're going to have like a 200 basis point surge in the 10-year yield. If that happens, the Mag 7, the entire stock market is going to implode because that will significantly tighten financial conditions. This is the mistake that Burns made. And initially, who is the guy after? I forget his name is on the tip of my tongue. Arthur Burns, and then it was
before Volcker.
Volcker, I'm sorry. So the Volcker initially made a mistake, right? Then he had to tighten more aggressively, tighten the markets way more than he should have. It looks like Powell's making the same mistake, but on an exponentially higher clip. So my view is rates have to go higher because inflation is inflecting higher. And as a result, you're going to get a massive sell-off in the markets to include the Mag 7 at some point this year. So that's not a view on the specific stocks. That's a macro approach that I think you can apply to the Mag 7, but that would be my take.
Yeah, wow. And so just to put a bow around it, you don't see it as anything different than the Nifty 50 or the .com.
No, in fact,
Yeah.
I think it's going to be worse.
Wow. So in a recent post, you had
Gary, think about this. I'm sorry, I didn't mean to.
No, go ahead.
You have Wingstop. I was about to curse. I'm not going to curse. You have Wingstop trading at 22 times sales. I'm sorry to pay them. I mean, anyways, let me calm down.
No. I could hear you. I could hear your frustration over the way the markets have been, I'll say, engineered through this time. And unfortunately, what that means is the backside is going to have some severe consequences for real people out there.
It's not fair because I'm not rich like you. I'm not rich like all these guys on Twitter. I don't make a ton of money. So, it's like I'm refusing to participate in this casino of a market. And it's like the Fed is implementing these policies that are really hurting me from an inflation perspective. I shouldn't have to participate in an engineered market that isn't based on fundamentals, but they're almost forcing me to. And that's why I'm angry, because when I go to the grocery store, my costs aren't up 3.0%. They're up a lot more than that. And it's really hurting me.